Well, now moving on to the next session. It is a power-packed panel discussion around the topic, Unleashing Innovative Strategies to Overcome Financial Crunch. But before we move out to that session, I can see a lot of people standing out there, and there are a lot of empty chairs to my right here, so request you to please take a seat there, take your seats there. Another humble request is, we are all gathered here to listen to some good, insightful sessions, and therefore I would request all of you to please keep your phones on silent while we set the stage. It is my pleasure to move on to our next segment. I've already mentioned the topic. I'll repeat it again. Unleashing Innovative Strategies to Overcome Financial Crunch. And I would like to invite on stage our panelists first, Mr. Anuj Tewari, co-founder and CFO, Yulu Bikes, Mr. Sunil Jain, Managing Director, Sprout Capital Advisors LLP, Mr. Trivesh D, co-founder and COO, Tradejini, Mr. Vishesh Jhol, Director, Sales PayU Payments, Mr. Virjin Jawahar, Assistant General Manager, State Bank of India, and last but not the least, Mr. Mohit Gupta, Senior Director, Sales Dun & Bradstreet, who will be anchoring this session. Over to you, Mr. Mohit Gupta.
Good morning, everyone. While I was dressing up for the day, I thought it's a little difficult to decide when you have with you the startup promoters whether to have a jacket or not. But then I saw my SBI colleague and said, "Let me continue with the jacket." So, startup is something which is, I think, maybe unique to the world, but not so unique to the Bangalore. Bangalore is the startup capital of India, and I don't know how many of you know the first unicorn India had was from Bangalore, and that was way back 2011. Any guesses, guys? InMobi, yeah. So I have a very fond memories of InMobi because Naveen was a neighbor of mine. We used to live in the same building. Now, of course, he's much richer, lives in a much bigger bungalow. So what startup does to an economy is something really crazy, right? And if you look at the stats which DIPP released, this Department of Internal Trade and Promotions, so we have close to 1.3 lakh startups registered in the country and providing close to 12.5 lakh employments. And that's a crazy figures, right? And I won't go into too much of figures because I think Avinash covered a lot, so I'll straight away get into the agenda today. And while we run this panel, we'll try to cover three things. One is on the capital raise, second is do's and don'ts, and third, how tech can make things really, or how can tech change a landscape for a startup? So I'll start with the panel with my first question to you, Anuj. And of course, you can resonate, Anuj, with all the bikes that you can see around the city, the Yulu bike. So thanks, Anuj, for joining us. So my first question to you is, as a co-founder and CFO of a electric mobility company, how do you evaluate pros and cons of different funding options? Because today, for a startup, there are multiple avenues available. It's not only the venture funds, you have debt funds, you have alternate investments, etc. But at what stage, what is right? Maybe if you'd like to give a flavor of the same to the audience today.
Thank you, Mohit. Great question. So as a startup, we are always, hungry for more funds. It could be meeting your expenses, scaling up. One piece of advice which is very important is always look at what is your capital requirement and what you need capital for. Very careful because money has color, right? So look at the risk profile. There are certain avenues, lot of avenues option available today that can go from the leasing platforms. There are venture debts, there are traditional debts, equity providers, venture capital. Looking at the state of the business, this profile changes. But one thing to keep in mind is always keep what is your exit strategy. Look long term and build your business so that you think of you as you are going to list someday. So set the seed for the governance. Look at capital, how soon you can be attractive for people for like SBIs, how people will evaluate at that point of time. So yeah, so my piece of advice would be, and one very important pocket which is very good, which we have actually used quite well, has been sustainable impact funds, DFIs. Do look, keep an eye for them. And then certainly when you are starting the journey, look for the right kind of venture capital funds and probably strategic partners. So yeah, it's a mix. So sorry, it's not a simple answer, but it changes, the color changes as you grow. But you should always keep in mind how you will be attracting when you will be large enough, or suppose you are going to be listed someday. So keep that in mind and set your cap table and fund mix accordingly.
And maybe just a little bit elaborate on that, since while we were discussing, you said when you started, it was all your friends and family which pulled in, and then probably the journey started. And then, of course, you would have seen various rounds of fundings. So maybe some experience that you would like to share.
So we were lucky in a sense, see, again, interesting fact with InMobi, so the main founder, co-founder who started the journey, Amit Gupta, he was also co-founder for InMobi. And when we thought of starting Yulu, we all have done this as our second or third stint, right? We are 40 plus. So that brings a kind of experience, and you are not, it is easy. We are not, the FOMO is something which, we don't have. We are okay. We have seen the funding. We have seen the cycles. I have seen 3 sessions in my career. So, things come and pass. So you are a little more resilient, I would say. So when you are starting like this, when you see the founding set like us, so there are a lot of people who want to, join your cause.
Thanks,
So
Anuj.
it helps. Again, very situational, I would say.
Thanks for sharing that. So moving on, I think while Avinash was giving a brief, he did mention about the funding winter for the startups, and maybe I think who better than Sunil to address to the audience in terms of, of course, it's a phenomena which has now prolonged. So what do you see are the other options available for startups, other than, of course, the startup funding, which is still happening, but not to that extent?
Yeah, so, I run a couple of businesses. One of them is advising startups on raising capital, and another is a venture capital business, right? Like Avinash pointed out, the funding is down by 50-60%. But sometimes, when you're put in a dark room, you think that you're buried. But what you don't realize as founders is that you've been actually be planted, right? So it's for the founder at that point in time to actually emerge from that darkness to figure out alternatives for the business. And there have been great examples over the last few years. The last 5 to 6 quarters, we've seen companies, tapping into alternative credit. There are certain alternative credit funds, and these are not venture debt funds. Venture debt funds typically participate alongside an equity round, most of them. But there are alternative credit funds which have emerged over the last 5-6 quarters who are keen to, lend maybe at mid-teen kind of returns to slightly mature startups. I'm not saying seed stage startups, but probably a Series B, Series C, Series D startup. That's one avenue. The other is we've seen a lot of op-lease/financial lease companies. So that's another. I think Anuj mentioned a lot of fleet operators where you do leasing. So that's an alternative which has emerged. We've seen companies which are tapping into operating leases or financing leases in terms of mostly financing leases in terms of funding option. Interestingly, it's also a point in time over the last 4-6 quarters, you've seen a lot of retail companies are tapping into something what I call as off-balance sheet financing. So in the retail business, traditionally most companies invest in the retail stores. Today there is an option of doing a FICO or a FOCO. It's basically a franchisee invested but company operated kind of financing. And a classic example I would give is Bluestone. Started as a completely D2C brand. They've closed last year at about 1,200 crores revenue. 85% of that has come from offline. And most of that offline got funded through a franchisee-owned, company-operated kind of a story. So that's another avenue for companies to tap into. There are enough mid-layer investors available in the market who are willing to take that additional risk. These may not be institutional capital, these may not be VCs, or these may not be private equity investors, but there are platforms today available. There are P2P lending platforms which have emerged, which are, probably allowing you to, create these kind of deal structures. There are wealth managers whom you should access, and the wealth managers are selling some of these products to their HNI clients. So these are few additional options available over and above, the traditional debt, which is always accessible, right? So those what I would say are some of them.
Maybe let's add to that. What is a banker's view on this, Mr. Jawahar?
So from the venture capital side, yes, already rightly sir pointed out, there are many, other than the traditional funds, like many venture capitalists as well as P2P lending, crowdfunding, everything is happening. From the banker's perspective, of course, the maturity of the startup matters. At what stage the startup is placed. So accordingly, banks will be tailor-made financial solutions for the startups at that stage, so that with a minimalist risk appetite. So far as financial institutions are concerned, the main challenge is bankers always look into tangible assets. So in case of tech startups, tangible assets, getting a tangible assets will be a challenge. So that's the reason government also have seen that particular pain point. So they brought out the credit guarantee trust. With that, we have been financing, we can finance startups. Other than that, even SIDBI, they have a fund of funds scheme for financing startups. Again, in case of core startups with where they are exposed to even different supplies, all these things, where my cash visibility is very clear. And even though the equity round may be happening at one side, but still my cash flows visibility is very clear, and that I want to ease out that particular avenues to get a bank financing. That is also very, it can be done very easily by cutting off those cash flows and making the bankers comfortable by doing a cash flow based financing. So that can also be done easily. In fact, we have, being SBI, being the part of the market leader in startups, obviously we have already done it. Practically, bank has financed such, looking into such startups where they want to ease out their working capital by way of a bank financing, so that they can they can focus on their core area with their equity financing. But yes, I have a regular cash flows, I will able to ease out those things with my bank financing. So that is also a good viable option.
So maybe Sunil, I'd like to extend this point, what we are discussing in terms of the funding options. And as a Sprout Capital, and you mentioned about the alternate funds, maybe if you can elaborate a bit more in terms of how you actually are helping the startups, and maybe any cases that's already in public domain that probably you can talk of.
No, sure. So, a couple of, I'll probably give you anecdotal examples of, innovative financing which we've done for a couple of startups. And this is more from an unlocking perspective, given where equity financing has been, mostly dry for a lot of startups. So one of them is a startup, which was setting up asset-light businesses, and their investment was largely in working capital. And unfortunately, nothing against the banking system, but unfortunately, banks want more mature companies, or they want tangible assets, as he mentioned, right? So we have actually, tapped into alternative credit, and these are AIFs, which are, alternative financial institutes. We have actually gone and securitized the entire cash flows from the retail outlets, done a revenue share with the lender here, and we've got, access to capital which is being utilized to do the expansion for the startup. Now, the startup continues to burn money at the corporate level. There's a G&A expense which is there. But expansion of business is what will, offset their burn. And that's where, we've got them this expansion financing, which is being funded by a third party. That's one example of a deal which we've done recently. We are currently, also doing a transaction where we are helping, and this is not a startup exactly, but, again, this is an institution, this is an online business in the edtech space. Whatever has happened with the market leaders in edtech is also had a rub-off effect on a lot of companies within the edtech ecosystem. So this was a cash-rich edtech company, no tangible assets. they don't have the ability to award certificates because that in India lies with universities. So this is, an edtech company which is utilizing universities or the ability to, give out certifications at one end, and the other end, tapping into consumers. And it's a new set of consumers. 97% of their consumers are tier 2, tier 3 students. Interestingly, 85% of them are working professionals. Okay. And this edtech company is 2.5 years old. Equity investors were, kind of not buoyed or not excited with another edtech opportunity. So we've got, again, a fund who's, put in about $10 million into this company purely as, a structured convertible. So 85% of this is, a pure NCD, and 15% is, structured as a convertible. So that's another transaction which we have done. I mean, these are anecdotal examples. I'm not naming the companies, but I think it's about going to the market and convincing investors that, you need to take some kind of a risk call or some kind of an equity call on certain set of companies. And that's what we've been trying to do over the last 8-10 months.
No, I think that's great insight into some of the work that's happening in the current market, especially when the funding winter is prolonged. Moving on to the next section of our discussion today, which is on do's and don'ts as a startup. So my first question to you, Trivesh, is while you are making a pitch to set of investors, what cautions or what suggestions you have for the audience in terms of while you make a financial forecast or growth forecast, what are the do's and don'ts that you would suggest out there?
Yeah, thanks Mohit, thanks for that. So we run a fintech discount broking firm called Tradejini. The funny part is I may be the least competent to answer that question because we have not raised money. We've been a bootstrap company for the last 10 years. We've been luckily profitable for the last 10 plus years. And but the part is I've seen a lot of companies pitch to us saying that how do we take part in the entire ecosystem of finance? Like everybody mentioned, stockbroking is, and the stock markets are picking up a lot of steam. People are enjoying taking part in the stock market, the listed space. Obviously, the unlisted space has its own color, has its own feel. The listed space has its own excitement because when you see the price move up and down and your heart is throbbing every second, it gives you another kick. And because of that, a lot of fintech players like to participate with players who are involved with the exchanges, and because cracking regulations is a very, very big thing. So what we have learned over the years, saying that what are the do's and don'ts typically is that don't oversell. The predominant problem that we have seen across the industry is overselling and underdelivering. Where promises are made on TAM saying that this is what is my addressable market, but then there are variations to that, what is sustainable market, what is global market, etc., etc. And those, you're only trying to confuse the person who is in front of you. You're not really making his decision easier, but you're trying to bring in more and more words and more connotations saying that this can happen, that can happen, but the reality may be far away. And that, I think, is the biggest red flag for us when you try to oversell, saying that we can do this, we just have to take a percentage of that market and we will be away in terms of our business. That is one of the biggest don'ts. The biggest do's is that where you're not planning for an exit. If you don't plan for an exit for your investor, it's a great do for us because we typically are strategic investors. We are not financial investors per se. So when you're looking at something, when you're not thinking about an exit, saying that we'll grow together and make it a long-term partnership, I think that's the biggest do for us. It may be obviously very different for a venture capital fund, for a banker, because for them it's an 8 to 10 year period that you're looking at because you have to roll over your fund. And I think that way it's very difficult for you to, not difficult, it's different for you to approach different set of investors. And you need to be cognizant of that, saying that who are you approaching and what is the requirement that you really have.
No, I think that's great. I think those insights could have come only from the person who has evaluated multiple pitches rather than made pitches. So I was right in asking that question to you. Moving on to Vishesh, I think you represent sales for PayU. And what do you think, maybe in your perspective, for a startup in terms of when they make a pitch, and probably when you're making the pitch, it always brings a lot of credibility if you have in-depth industry knowledge or the product knowledge. So from that perspective, any take that you have that the people or the folks while making those pitches should include some of their strengths while they make a pitch?
Thanks for that question, Mohit. Not just from a sales perspective. I mean, that is when we want to go to a company when they're already large. That's where PayU is interested in you. But we run this accelerator fund. In fact, the first version of it was last year specifically for fintech. We got about 400 odd applications there. Looked at a lot of startups. It was specifically focused on fintech, so we understood the businesses there. Most of my time at PayU has been in building a couple of businesses. So I think what we're looking at, especially in fintech businesses, is one, that you have to have the experience. You don't really build a lot of financial services businesses. Tech is always going to enable something in financial services, but it's pretty much going to be financial services at the bedrock. And I mean, we have a banker on the panel, we have someone who's worked in private equity, someone's working in venture capital. A lot of these businesses need to understand regulation. That's at the core of it. That's why experience matters. So highlighting that in your pitch really matters. Talking about a product market fit that you see, that it's not, it could be solving a problem that's not solved for today, but it has to have some understanding of how it can actually be executed in the realm of the regulations that you operate in. Those are things that we look at, and mostly in fintech startups, we'd also look at someone who's sort of gotten product market fit to a certain extent, even if they're coming to an accelerator fund and trying to get distribution mentorship. So what we do help them with is a lot of distribution. So say if you're a BNPL provider and you want distribution with PayU, we'd help you with that. If you're a cross-border company and you want to work with SMBs at PayU, we'd help you with that. We help with a lot of GTM in that sense. We, in fact, recently funded a company from that accelerator fund, BriskPay, announced a couple of weeks back. Those are things we'd look at. So I believe experience in the field, being able to demonstrate some bit of product market fit in the realm of the regulation that you operate in, as well as some bit of understanding, like Trivesh also mentioned, it's not about the exit. We'd also look at something which is strategic. So we, at a process level, maybe financial investors, but mostly at a PayU level, will be a lot more strategic in terms of what's fitting our operating flywheel. So those are the things that we look at in a startup.
Sure. One of the other points that probably, I've been a commercial banker for 2 decades, and when I saw a company trying to raise debt and that proposal reaching out to me through multiple brokers, for me it was a red flag that why so desperate and there are multiple people approaching. So maybe in the same way, maybe, and this is a question to you, Anuj, is when the startups are looking to raise capital and make pitches, what should they avoid? And that probably make their pitch more formidable.
So now you have to approach the pitch in 2 ways. One thing is there will not be one pitch. So one is for the reading when you're circulating. Keep that very simple. Don't change the flow. There is certain standard people expect to look at the set. There will be summary, elevator pitch, there will be team, problem statement, market, competition, forecast. Keep it there. Don't change that. Then you have to have another pitch when you are doing a presentation. When you are having a presentation, you have a captive audience, right? They cannot run out of the room. So that is time when you have to make what is most attractive in your business. Make more and more visuals. But at the end of the day, what he rightly mentioned, don't oversell. And if you are, then you have to have couple of scenarios. I understand you want to get maximum valuation out of your business idea and all, but at the end of time you have to be realistic. So you have to present different case and scenarios and always be open about what could be the risk to your forecasts. So you have to have all those elements. But in the end, keep it simple.
Thank you. Maybe Trivesh, you talked about, do's and don'ts when it comes for financial projections. Maybe your views, since you evaluate a lot of proposals in terms of the pitches that you have liked and why you have liked and why haven't.
Sure. Interesting question. So the pitches that we typically like is something that is solving for consumption today. For example, we were evaluating a company which is into data servers. Data servers is not very interesting as a business. It doesn't excite people because it is basically you have to set up servers across locations. You have to cater to larger clients who require the servers physically located in a particular place, connected to a particular system, and its uptime has to be typically above the 99%. And this is the pitch that we received. Like Anuj also said, the format is set, and if you don't follow it, it confuses the guy who's reading because he's used to a particular format of seeing that document. And when it's not in that format, you get a little startled, but it may be a risky move. Like this company we are evaluating sent us just one pager. They sent us this one pager saying, we do data servers, we help companies set up colo or direct servers if needed. And that is all that was. And when we spoke to the founder was very critical of saying that I am not sure of the entire potential of where this business is, but I know that to start off with, I have 1, 2, 3, 4 things in my mind, which is fairly reasonable, not overselling like I mentioned again, but very sustainable growth. One of the topics for today is sustainability. And that for us was a great pitch for us to say that you've come with a plan to say, I know what I'm going to do for the next 2 years, but after that I will figure out, but I will also need your support. And that's where we as strategic partners come because we have certain experiences that we have gone through already to know what we can also do to improve our selling, to cross-sell probably, and to increase your market expansion. I think that for us was a great pitch that came to us. One other pitch, I'll just take a minute more, that came to us was in terms of another tech business. And tech businesses generally, obviously SaaS businesses are there, all typically driven by ARR, etc. This business went on the B2C side where it was a subscription-based business. And they said that while we want to do a B2C today, we would also like to do B2B2C tomorrow, B2B also tomorrow. These are typically red flags because you say that you're not focused towards one. But the vision of the founder was very clear, saying that today the play might be B2C. But I know that the potential for this product to go into a B2B market and a B2B2C is very evident. So I don't want you to curtail me to say I will only do a B2C or a B2B. If you give me the freedom is when I want to partner with you. And he was very clear. And I think that was again a very, very sensible thing for him to come up to us saying that I want to do this. And that gave us a lot more conviction about him and his product, saying he knows what he's doing.
Yeah, I think that's very important when you have a very clear thought laid down in a PPT or a presentation or a pitch you are making. And that's really give a lot of conviction to the investor fraternity that the promoter is very confident and very clear of the roadmap. Moving on to our third part of the discussion today is where we want to discuss how technology can enable efficiencies and optimize costs for all. And maybe Vishesh, if you can help everybody understand that how tech has played a role in terms of PayU's growth and the efficiency that PayU could drive, leaning on the tech that probably came into your organization.
Fair enough. I mean, that may be too big for my shoes, but let me take it this way. PayU started as an accident in some senses where we were trying to solve for the problems at IBO, and we thought that this is now scalable and we can take it everywhere. So that alone, I think, as a story is quite remarkable in terms of how we started. So every startup, when they're starting, should probably take a leaf out of that you're trying to solve one problem and you can try and solve it for probably that one customer or that specific set of people and then grow out of that. Anyone worth their salt in this field started like that, BillDesk with some government accounts, Razorpay on the SMB side, and so on. So I think solving that specific problem is very, very important. How I think tech today is sort of available for a lot of people to scale up. So that usually does not become a challenge. Digital payments as such now are offering you everything that you need if you want to be a startup that is in digital payments and is scaling, or even any field in fintech, right? Now you don't have the problem of, I was talking to, there was some time that I spent at Snapdeal, and I was talking to Kunal on one of these discussions, and he said, you know, our job in 2012 or 2014 used to be reaching our office and chasing rabbits every day. Like, there is payments to chase, there's operations, there is third-party logistics, there's just so many things now that are solved for a lot of founders, so probably the best time to start. The other thing I'd say is that we and a bunch of other, even venture capital firms and so on, are providing a lot of platforms and credits for startups to start. In fact, a friend of mine who just started up was telling me that he's gotten credits that are worth $100,000 already for AWS services or all the softwares that they have to use. So I think the platforms as well as the support for the startup community exists today in terms of tech that can make you scale. That pretty much depends on which sector and where do you play. I mean, EV is very different. We were talking about that from an interoperability point of view, from a charging infrastructure, or there is trading today that just shot up during COVID, and then now a lot more retail investors. So you have to scale up there. Depends on the sector, but what I'm saying is now there are platforms as well as a very, very rich ecosystem available to support you if you want to grow quickly.
Yeah. Maybe Anuj, you would like to add a flavor, like say when you started and where you are today, tracking your vehicles, people used it, left it, how they made a payment. I think tech would have been a backbone now for the infrastructure. Maybe you want to share a flavor in terms of when you started the costings, and now when you have a very advanced terms, how the efficiencies have flown into your business.
Thank you. So with us, actually, we were always a tech-first company, and of course, as more and more data pile on, business efficiencies kick in, and that starts right now, right just where we have to place our parking stations, right? Where we see the more footfall, where more and more apps are opening. We understand that people are looking for the bikes, so demand pockets are there. So that helps us in positioning our bikes. Second, for example, over the time when we know how the bikes have been used, how the bikes have been used, each bike, what kind of journey it had, how many potholes, how it was driven, it helps us in actually predicting the maintenance schedule for that bike. So right now, how to relocate, route optimization. So tech is actually everywhere. The data actually is the power of data is right from demand forecasting to the how you can drive the cost efficiencies, how better you can utilize your manpower. So yeah, so that has improved, and it keeps improving as you actually accumulate more and more data.
So not only planning efficiencies, but also the course correction probably that can be.
Of course, course correction, very much course correction right now. For example, even how our bikes were getting used, what could be the right pricing, how people are using, for how much time they're using, so those all actually you get from the data. Yeah.
So maybe my last question to you, Sunil, before we wind up and allow last 5 minutes for audience to ask questions. As a guy who is evaluating proposal and looking to invest, what are the key things that you look from the tech landscape for your investing companies? Tech landscape, sorry.
I mean, I am a strong believer that there's no business called tech business. You know, there is a business and tech is an enabler. What is the quantum of technology which is utilized in a sense of a business, either to drive, efficiencies on the revenue side or to drive efficiencies on the operational side to optimize cost? I think that's how we look at businesses, right? I mean, a lot of founders write to us saying, it's a fintech business. There is someone actually, wrote something called medtech, and there's it's all fine. In terms of the jargons, but I think when we evaluate a business, what we are trying to evaluate is that what does this business solve for, right? It could be a B2B business, it could be a B2C business, and tech is an enabler. I think the larger thing which we see in terms of technology today is like Anuj mentioned, there are a lot of tools available today in the market for you to, get a kickstart. But in terms of what you're solving for, could be very different from what the market is offering.
Yeah.
So you as an organization, as a founder, need to figure out which are the tools which I will take from the market, which are the tools I need to build in-house, and how do I integrate these in terms of build versus buy, and then, produce an outcome which will lead to efficiencies. I think that is what we look for in the companies where we invest, because we largely invest in businesses. I mean, it could be a B2B business or a B2C business. I don't believe that, technology is a business. I think it's an enabler, and it's been happening since time, right? I mean, and the enablement of technology could be different for different businesses. That's how we look at businesses.
Thanks, Sunil, for that insights. And maybe just to summarize for the discussion today, we covered in terms of the funding options, the alternate avenues that are available for startups, the do's and don'ts in terms of what to pitch, what not to pitch, how the financial statements or the growth statement should be positioned in front of the investors, how tech as an enabler to your business can bring in efficiencies and help you in terms of your valuations, etc. With that, I'd like to thank all my panel members and try to conclude. And before I conclude, maybe I have time for two questions, 2 or 3 questions, quick one, if anybody has anything to ask.
Hi Anuj, my question is to you. Since you're in the leasing space, I think you're one of my closest allies. So to give you just a quick context, we are looking out to solve the problem of parking in Bangalore. And in the space of parking 5 cars, we should be able to park about 50 cars by going vertical. The challenge I'm facing right now is this business is not viable unless and until I'm able to hit very low interest rates. Because right now the leasing space, as you see, most of the financial lenders are lending anywhere upward 8% and upward 8%, right? The interest rates. So I'm looking to hit interest rates of about 2 to 4%. And do you have any visibility on that?
First of all, thank you. As a Bangalorean, I really have full sympathy
All of
and
us.
wish you all the best. You do succeed. And when you say 8%, you mean annual rate 8%. And 8% is a very good rate in my view. If you're getting that, and 2 to 3% is over ambitious when your saving deposit is giving you 6%. But I would say there are still, if I will again go back to what my first answer was, look at some pockets which are looking over the ESG overlay. Usually they are not only driven by the commercial reasoning, but they have reasoning beyond that. And those pockets, those DFIs actually help you bring your cost of funding much lower than what you can actually manage through the traditional or exotic financial institutions.
So maybe I think to summarize, maybe any set of investors where the cost of capital is being subsidized through a sustainability agenda, and that helps you in terms of a capital raise.
So IFCs, DFCs
It's
could
be very difficult to get 3% in India. Risk-free rate is 6.5%, 7%.
Yeah. Right. Any international funds?
The hedging cost in India today is about 500 bips. It will be very difficult for you to get dollar money and assume that there will be a zero hedging cost. Unless you have a business which is naturally hedged against dollar.
Still, even if you look at the Sofitar bar and LIBOR and all, they are right now anywhere between 4.5 to 7%. So I find it very difficult what you are looking for, but yeah.
And these being infrastructure projects, these are at that massive scale as well, right?
Still.
So I think maybe if you can get some, some aid, the funding aids, which helps you to get a blended cost lower. But like say, raising money from a formal channel or an informal channel, I think 3% or 4% or below is something not heard in the community so far. And as rightly what Sunil was mentioning is dollar funding, unless until the asset and liabilities are in the same currency, runs a currency risk which needs to be hedged. The hedging cost itself will make the overall cost beyond 8%. So dollar funding may not be an option unless until the investor is willing to keep the currency open or unhedged. Maybe one last question before we wind up. Anyway, thanks for asking that. That's
Yeah, again, this question is for Anuj. So Anuj, initially when you would have conceived Yulu as a product, you would have visualized like normal people like us going from point A to point B. But over a period of time, we saw that a lot many delivery people started using. So was there a plan for them, or when, at what point you decided to cater to that segment also?
So interesting question. Again, we did started only as what we call people mobility, solving for the last and first mile. People going commute, going to the offices, schools, or coming back from offices and schools using some mid-mile like metros or buses. That was our initial use case. During COVID, actually, when everyone was sitting at home, and we saw that our usage almost dropped practically to zero. At that point of time, we saw some people were still using it. And if you remember, at that time, e-commerce actually exploded. Home deliveries exploded.
Yeah.
And then we found out that
A new use case.
A new use case. To the extent today, almost 80+% of our bikes are getting used in this use case. And then at that point of time, and again, we have not, it was not by design, it happened by, again, you can say accident by chance or serendipity, whatever you may call. So then we decided if there is a use case, there's a need for it, then why not? So that is why you would see now gray color bikes, which is actually positioned and targeted towards that segment. Yeah.
Thank you, Anuj, and thanks audience for patiently hearing our views. So thank you a lot. Thanks a lot.
Thank you.